So last week, everyone turned their attention to the Federal Reserve in anticipation of Kevin Warsh's second FOMC meeting as Fed chair and whether the Fed would hold rates steady or if a surprise rate hike was in store. Now, prior to the announcement, which was last Wednesday afternoon, markets dropped more than 1% intraday as everyone waited to see what the Fed's decision would be. And as we now know, the Fed decided to hold rates steady, and markets responded by rebounding some after its earlier losses right after the announcement, but it still ended the day down over 1.5% on news related to AI data centers and the Iran war, and just digesting what all of the Fed minutes and everything meant. Now, according to CME FedWatch, more than 60% of traders and analysts are putting higher odds on a rate hike going into September, especially with inflation fears getting stronger again as oil prices spike from the continued war with Iran. Now, none of this seems all that groundbreaking or surprising to people who pay attention to market activity. But while most people simply look at the Fed funds rate and call it a day, Wall Street watches something else with an equally wary eye right now. And while talking heads and the vast majority of financial headlines are focused on, cut, raise, hold, and that whole narrative, more and more people are starting to see and feel the disconnect between what the Fed does with the Fed funds rate and how that actually ripples through the economy to things that people actually care about, like mortgages and car loans. And you only have to look just a little bit beneath the surface to understand why. It has to do with the idea of term premium. Now, admittedly, that does not sound particularly interesting, but before your eyes glaze over, understanding this idea will help you make sense of why the economic ground feels like it's been shifting underneath us over the last few years, because in a lot of ways, it has. But let's start with the story we all know, which I've talked about at length before, but for the sake of everyone being on the same page, if you're not familiar with it, the Federal Reserve, through the Federal Open Market Committee, which is the FOMC, controls the federal funds rate. This is the short-term rate that banks charge each other for overnight loans. Now, on the surface, it's a really simple tool. Typically, when the economy is overheating, the Fed raises rates to make borrowing more expensive, cool down spending, and get inflation under control. We saw this play out in 2022 and 2023 when the Fed launched one of its most aggressive rate hike cycles in history to try and combat record levels of inflation. Now, conversely, when the economy is weak, the Fed typically cuts rates. Cheaper borrowing is supposed to encourage businesses and consumers to spend, stimulating growth. And the Fed took that to extreme lengths when it cut the Fed funds rate to near zero in response to the Great Recession coming out of 2008. And kept rates low for many, many years. But the expectation in all of this is that as the Fed makes changes to the Fed funds rate, the shortest term rate, that will generally influence longer term rates. If the Fed cuts rates, hopefully that means bond yields and by extension, consumer rates go down as well. Same is true for increasing rates. If the Fed increases, that means bonds will increase, interest rates will increase, so on and so forth. And one of my favorite metaphors for this comes from an economist named David Altig, and he's actually part of the Federal Reserve in Atlanta. And he put it this way: I have a simple way of thinking about how monetary policy works. Imagine a long rope. At one end of the rope are short-term, relatively riskless interest rates. Farther along the rope are yields on longer-term, but still relatively safe assets. Off at the other end of the rope are multiple tethers representing mortgage rates, corporate bond rates, and auto loan rates, the sorts of interest rates that drive decisions by businesses and consumers. He goes on to say, in the textbook version of central banking, the monetary authority grabs the short end of this allegorical rope where the federal funds rate resides and gives it a snap. The motion ripples down and hopefully reaches longer-term U.S. Treasury rates, which then relay the action to other market interest rates where the changes reverberate throughout the economy at large, end quote. And for a long time, the market did seem to follow the Fed's lead, and everything that was just described was true. The Fed would snap the rope, if you will, and other interest rates would respond in tandem. But lately, no matter what the Fed does on their side of this rope, long-term yields aren't responding as people have historically expected them to. And we felt this acutely over the last few years, especially in the period spanning late 2024 and into 2025 last year. The Fed started cutting rates, yet long-term borrowing costs, especially for mortgages, remained stubbornly high, and in some cases, it even went up. This left millions of prospective homebuyers both scratching their heads and feeling really frustrated at being priced out of homes they otherwise may have been able to afford in the past. So, if the Fed was cutting rates, why isn't a mortgage getting cheaper down this proverbial rope? Because while the basics of monetary policy may generally hold true as the Fed tries to combat inflation, there's another powerful force at play, one that operates beyond the Fed's direct control. That force is the bond market, and one of the key terms is that term premium. To understand what Wall Street is really watching here, you have to look past the Fed funds rate and turn your attention to bond yields, and specifically the 10-year US Treasury yield. This is arguably one of the most important numbers in global finance. It's the benchmark for countless loans, from corporate debt to, most importantly, for the average person, fixed rate mortgages. So while not a perfect lockstep, the rate on a 30-year mortgage tends to follow the 10-year Treasury yield. And the reason that mortgage companies use the 10-year bond as their benchmark is that while most mortgages are 30 years long, the average borrower, at least historically, typically sells or refinances every 7 to 10 years. So the 10-year Treasury is a really good barometer for the actual risk that a lender is taking on. But what determines the 10-year yield? And this is where it's getting interesting. If you look at widely used economic models on this, including the models used by the Fed itself, yields are mostly determined by two major components, not completely, but mostly two components. The first part is what you'd expect. What is the market's collective best guess of what the Fed short-term rate will average over the next 10 years? The second piece is that crucial piece of the puzzle, term premium. So in simple terms, investors want to get paid more the longer they loan out their money. It's the basics of risk versus reward that any reasonable person would expect. So think of it like this. If a friend comes to you and asks to borrow $100, but they'll pay you back by the end of the week, you're not taking a ton of risk on, so long as you believe that person is trustworthy and capable of paying you back. Welcome to underwriting. But what if they ask to pay you back in a month? What about 6 months? What about a year? The longer period of time they want to borrow money, the term, the more risk you're taking. So if you're taking more risk, what do you want to get? More reward, or else why would you take the risk? Because more time equals more uncertainty, and a lot can happen. Inflation could unexpectedly surge, eroding the value of your money. You could miss out on better investment opportunities. The borrower's situation could change dramatically, putting their ability to pay you back in question. And that's not because your friend became implicitly less trustworthy. It's just the reality that the further into the future you look, the more uncertain it becomes. So the extra compensation is this term premium. It is the additional yields that investors demand for the risk of holding a long-term bond instead of just rolling over a series of short-term ones. It's the market's price for uncertainty about things like future inflation and interest rate changes, among other things. But much like so many things in economics, this premium is not a fixed number. It's dynamic. It fluctuates based on investors' changing fears and risk perceptions. And for years, especially after the 2008 financial crisis, model-based estimates of the term premium were incredibly low and at times even negative. You heard that right. There was a point in time where investors were willing to accept less of a premium for holding on to longer-term bonds. And if that sounds strange and totally counterintuitive based on everything I've already said, it's because it is. In much of the 2010s, around the time some of our lowest interest rates in history were happening, the Fed introduced something that a lot of people are familiar with, but it hasn't been talked about nearly as much in recent years. But it's called quantitative easing. As I said earlier, the Fed doesn't directly control the bond market, but it did end up influencing it significantly in how it participated in buying bonds. In response to the Great Recession, central banks stepped in to buy up massive amounts of government bonds. And by massive, I mean trillions of dollars worth of government bonds. And there were 4 major periods of QE, as people have referred to it, with the most recent one happening during COVID. So why does that matter so much? Well, going back to our example of that friend who always seems to need to borrow money, if every typical lender, in this example, you and the other friends in the friend group, expect some sort of term premium for longer loans, what happens if a new friend shows up and they'll lend to your friend no matter what, with no tangible regard for how long the money is tied up? The expectation of a term premium essentially goes away. And that's basically what happened with quantitative easing. During QE, not only did the Fed cut rates, they also stepped into the bond market with trillions of dollars, buying up massive amounts of long-term US bonds. They were not trying to maximize their investment returns the way a private investor would. They just bought. Because the Fed was willing to absorb tons of riskier long-term bonds, regular investors' behavior had to follow suit, and term premium basically collapsed. So this suppressed long-term rates and gave very little compensation, if any, for holding long-term debt. But that era is over, at least for the time being. There's absolutely no way to know if the Fed decides to do another round of QE in the future, but for now, it is not at play. The term premium is back. So while term premium collapsed for a time period, it is back and people are feeling it, even though most people haven't been able to put their finger on why or how it's all connected. But now you can. This higher uncertainty fee, if you will, is a major reason why the cost of big ticket borrowing has gotten partially disconnected from the Fed's rate decisions. And the most direct impact for millions of Americans is on mortgage rates. We've already established that the 30-year fixed mortgage rate is closely benchmarked to the 10-year Treasury yield. Since the 10-year yield is made up of both future rate expectations and the term premium, a rising term premium can push mortgage rates higher all by itself, even if the Fed is standing still, or even if they end up cutting rates again in the future. But this isn't just about mortgages. The 10-year Treasury yield is a benchmark for a vast array of other borrowing. When a corporation wants to issue a corporate bond so that they can, raise capital to build a second headquarters, its cost is benchmarked against Treasury yields. And while not a direct benchmark to things like auto loans, because that's more based on the premium rate, but it's all influenced by the general level of interest rates and funding costs in the economy. Today, especially, without any QE on the horizon, investors are naturally demanding more compensation for longer-term bonds, especially as worries continue about persistent inflation, enormous Treasury issuance, larger deficits, geopolitical uncertainty, and the very real possibility that rates stay elevated for years to come. A higher term premium ripples out, and in doing so, it raises the overall cost of capital for businesses and loans for consumers. Now, the big question is, what does that mean for you as a consumer and as an investor? First off, and this is a general rule of thumb that I talk to clients about all the time, do not overextend yourself on a mortgage if you have to rely on refinancing it in the future. Now, refinancing at a lower rate can be a really smart financial move for a lot of people. Part of the reason so many homeowners are in golden handcuffs right now is because they refinanced during the historically low interest rate levels of the recent past, and they're sitting on way lower monthly mortgage payments than they were originally and than they could possibly get right now. But it should not be the basis of your borrowing decision. There have been so many people, especially between 2022 and 2023, who overextended themselves on a mortgage they could not functionally afford long term because they saw the higher rates and basically told themselves, it'll be fine, I'll just refinance when rates come down in a few years, only to now be in a situation where rates are staying higher for longer. Even at the beginning of this year, there were so many people, from traders to analysts to economists to talking heads. Everyone was expecting the Fed to issue more cuts this year. But now the market is pricing in a higher probability of a hike in September. And in fact, 3 members of the 12-member FOMC that voted last week wanted to hike rates even now. So Wall Street is finally coming to terms with a higher for longer reality of interest rates. And they understand it's not simply based on what central bankers decide. But, and this is, to be fair, this is just anecdotal personal experience that I have with clients and prospects and people I talk to every day. Main Street still seems to be holding out hope for rates to come down. And number one, I just don't see concrete economic evidence for that to happen in the short term or in the medium term right now. The Fed's target inflation rate is still 2%, and we're still well above those levels. And number two, even if rate cuts do happen, as we've seen today, it does not guarantee that borrowing costs will meaningfully follow suit because there are too many other economic elements at play. And investors are getting more cautious about buying treasuries because of the ballooning government deficit that is only going to keep growing. And people forget that the only reason we had such depressed interest rates for so long was in response to the worst economic slowdown in nearly 100 years. And I don't say that to stir up fear. I say it to help people understand that you cannot base sound financial decisions on wishful thinking. You have to accept the reality we are in, which means people need to prepare for mortgages based on where rates are now, not based on where you hope they'll be in the future. And the second thing this means for people is actually, in my opinion, a silver lining in all of this, which is that fixed income exposure in a portfolio is naturally giving higher returns than it was even a few years ago. And let me say it very clearly, as I always do. This is not investment advice. I'm not telling you to go out and buy more bonds or change your asset allocation. Those are deeply dependent on individual factors for every person. And no one on YouTube or otherwise should be giving out carte blanche advice about how you should invest. Frankly, I think that should be illegal, but it's not. Here we are. But fixed income is producing higher returns, which is good news for people in diversified stock and bond portfolios, at least in the near term. And where I see that affecting the stock market potentially is that because the term premium on bonds has risen and may rise more, savvy investors are going to start looking at stock prices with a more critical eye. And especially if this remains the new normal for bonds over the next several years, I will not be surprised if we see a momentum shift in stocks back towards a value tilt versus this crazy growth stock era we've been in for the better part of 2 decades. And the Fed absolutely still matters, and central banking decisions are key to how the economy functions as a whole. But even in his statement after the rate announcement this past Wednesday, Kevin Warsh said the Fed shouldn't be the center of attention in markets all the time. So if you want to understand why mortgages, business loans, and other borrowing costs aren't behaving the way everyone expected or the way you've been told that they should, don't just watch the Federal Reserve. Watch the bond market, because increasingly that's where the real story is being written. And as we come to a close, we're moving into the biblical frame. This is where I like to talk about how I, as a believer and a follower of Jesus, approach and think about this sort of thing. So we're moving out of the economics conversation and into the faith conversation. And as I was preparing for this specific video, at first, nothing specific really came to mind, if I'm being completely honest. And it felt like this goes back to a lot of things that we've talked about that I've said before. And I started thinking, what can I say that I haven't said before? And what kept popping into my mind is the fact that there are so many people, but so many believers who just don't engage with this. And if you're watching this video, this might be a little bit of preaching to the choir. But at the same time, I think people need to meaningfully take a step back. And number one, if you do pay attention, if you were watching the live stream of Kevin Warsh at 1:30 in the afternoon on Wednesday, you're pretty keyed in. If that's you, that's not most people, but if that's you, that's me, but that's partially because it's what people pay me to do. I think that checking your heart and making sure that your purpose and your drive and your goal in this is following Jesus, and what that means when it comes to meaningfully engaging with economic policy and central banking and everything that's going on with borrowing costs and how you're going to choose whether to buy a new house or get a new mortgage or refinance or whatever it may be, is that because you understand and are convicted by your call to steward your money well, and so you want to be well informed. That's why I do these. I want people to be well informed. I want people to have a meaningful understanding. But for believers, that meaningful understanding, that information, being informed, is not so that you can sound smart to your friends. It's not so that you can put yourself on a pedestal and think that you could do better than the people in the FOMC, or to sit back with your arms crossed criticizing everyone and everything around you. Now, there's a time and a place to call out certain things, but just in the day-to-day, when it comes to why are you engaging with it? Is it to steward your money well for the kingdom of God? Because that's what we're told to pray. When Jesus told us, pray it like this: Our Father who art in heaven, hallowed be your name. Your kingdom come, your will be done. Our goal is to see the furthering of God's kingdom. And that includes how we spend our money, how we steward our money, what debt we take on, what debt we don't take on. And all of those need to flow from a heart of love for Jesus and obedience to Jesus. Obedience not to gain favor. Obedience because we have a good and loving Savior, and his kindness leads us to repentance. But on the flip side, if that's not you, and so you somehow stumbled on this video and you've made it this far for a different reason, my hope for you is to encourage you, because you have been called to steward your money, because you have been called to view your money differently than the world. It is a means to an end, a means by which you feed sin patterns and continue on in unrepentant behavior, or it is going to be the means by which you get to meaningfully be a part of seeing the gospel go out to the nations and to your neighbors and to your coworkers and to those around you who need to hear Jesus, because we are here for his kingdom on our own. And if I can just talk to any women watching this, it's a carte blanche statement, and I mostly don't like blanket statements, but I see so many Christian women stick their head in the sands when it comes to money. Not just married women, single women, people in all different stages of life. You have a responsibility. If you're married, not separate from your spouse, but you have a responsibility to meaningfully engage with where your money is going and the decisions you're making. And you don't have to be an economist, and you don't have to understand the inner workings of the bond market to be able to do that. But there is something to be said for being well informed enough in order to meaningfully make wise decisions. You have to understand the framework within which you're making the decision. At least understand what you're doing when you're taking out a mortgage, why the rate is the way it is. And like I said earlier, if it comes down to we're stretching ourselves to get into a house we want that we can't really afford and we'll just refinance, I would strongly suggest that you look at your heart there. Because the Lord is sovereign over everything, including your bank account, including these interest rates, including the amount of house that you can functionally afford. Are you doing that because you feel called into that neighborhood to speak the gospel to those people and love those people radically? Or are you doing it because you want the pool and you want the bigger house and you want people to look at you and envy your life? Think about why you're making the decisions you're making. And when it comes to major financial decisions like taking out a mortgage, buying a house, buying a car, taking out a home equity loan, taking out a personal loan, taking out a loan for your business, you have to meaningfully understand what it is you're participating in order to steward it well. And like I said, you don't have to be an economist. You don't have to watch the markets every day, but you do need to be well-versed enough. We live in an information age, and there's just no excuse for sticking your head in the sand and not understanding what it is you're doing with your money, because you're called to something more. And if you've made a mistake, if you have stuck your head in the sand, his mercies are new every morning. He is a good and faithful and loving God, and he meets us where we are. And he meaningfully cares about everything in your life, including the stewardship of your money. And he's given you common sense. He has given you critical thinking. He has given us the basics of math and order in the universe for us to meaningfully understand these things and engage with them well. And if you need help, find someone trusted, neutral, objective who can help you. I will not be posting a video next week. I will be at the beach with my family for one last hurrah before kids go back to school. So I will see you back here in 2 weeks.